Hey everyone, welcome back to the Explainer. So today we're tackling something that is, well, let's just say it's a painful but absolutely inevitable reality for literally any business owner or financial professional out there. Selling goods on credit and then not getting paid. The dreaded unpaid invoice. We're going to unpack exactly how to handle these losses in the books, making sure your financial statements actually match the somewhat grim reality on the ground. Here's our roadmap for today. We'll look at what happens when customers just don't pay, how to account for those bad debts, and then we'll look at the happy surprise of a recovery. After that, we'll zoom out to the conservatism concept and how to proactively account for future losses. Let's jump in. Section 1. When customers don't pay and the harsh reality of credit sales. Let's start with a bit of a reality check. We all know credit sales are the absolute engine of modern business, right? You offer credit, you bring in more customers, your sales volume goes up. Simple. But it inherently comes with financial risk. What actually happens when a customer just flat out can't pay? You've delivered the product or the service, the invoice is just sitting out there, and bam, you find out your customer is insolvent. It's incredibly frustrating. It's the kind of news that makes you want to momentarily reconsider your career choices, for sure. Well, that specific frustration actually has a formal name in our world: a bad debt. Basically, it's the amount of debt that's unrealizable from a debtor, usually because they've become insolvent. But the absolute key phrase you need to drill into your head here is permanent loss. Since this money is never coming back, we can't just pretend it's still a shiny asset on the books. We have to bite the bullet and officially recognize it as a permanent loss. So how do we actually do that? That brings us to Section 2, accounting for bad debts and closing the debtor's account. Now, what's really interesting here is seeing how this real-world pain translates into a clean, logical journal entry. When a debt becomes undeniably bad, no hope left, we must close that specific debtor's personal account. It's straightforward. We debit the bad debts account, which books the loss, and we credit the concerned debtor's account. That totally wipes out what they owe us on the books. It's gone. But how does this whole thing show up in our final accounts? There are two really common scenarios that trip people up all the time. First, if bad debts are already inside the trial balance, the journal entry we just talked about, it's already happened. So you just show the total amount on the debit side of your P&L. Super simple. But if you find bad debts listed outside the trial balance, these are known as further bad debts. It's a two-step dance. You have to add them to the P&L debit side, and you've got to deduct them from sundry debtors on your balance sheet assets side. Don't forget that second step. Let's actually ground this with a specific example from our source material. Imagine you've got a debtor named Hari Singh. Hari owes your business 400 rupees, but unfortunately, Hari becomes insolvent. The court or the liquidator steps in and determines that creditors are only going to receive a final composition of 50 paise in a rupee. Basically, you're only getting 50% of what you're owed. Ouch. This brilliantly illustrates the real-world accounting split. Out of the 400 rupees Hari owed us, we get half. So we debit cash for 200. The remaining 50%? Gone forever. So we debit bad debts for that 200. And finally, we credit Hari Singh's account for the full 400 rupees, permanently closing out his balance. The math just perfectly reflects the grim reality. All right, let's move to Section 3, the surprise recovery, or what happens when bad debts actually come back. Let's shift gears to a way happier scenario. What happens when a customer you thought was literally gone forever suddenly shows up and pays you? Well, a bad debt recovered is an immediate gain. It feels like finding money in your winter coat. But listen, here is the golden rule. You do not credit the debtor's personal account. Remember, their account is already closed. We are not reopening it. Instead, the entry is beautifully simple. We debit the cash account because, hey, we got cash. And we credit a highly specific account called the Bad Debts Recovered account. Using this distinct account lets us recognize that sudden awesome gain without messing up the historical accuracy of our already closed customer accounts. That brings us to Section 4, the conservatism concept, where we learn how to anticipate the unknown. So we've dealt with known bad debts, the ones that already hit us. But what about the unknown? What about those invoices that haven't technically gone bad yet, but let's be real, deep down a certain percentage just won't be paid? This brings us to a really fundamental accounting philosophy. Anticipate no profits, but anticipate all losses. It sounds a little pessimistic, I know, but it isn't just an arbitrary rule. It's a highly logical framework. We don't count our chickens before they hatch, but if we see a fox sniffing around the henhouse, we prepare for the loss. Applying that exact concept gives us the provision for bad debts. Basically, this is an estimated provision, usually calculated as a percentage of your total sundry debtors, and we created at year-end to cover those expected future losses. Now, there's a really important distinction I want to make here. These debts are only doubtful, they aren't permanent losses, yet. Recovery is actually still possible, which totally changes how we record them. And that leads us directly into our final section, Section 5, Accounting for Future Losses, and exactly how we create this provision. So the crucial point is, because these specific debts haven't officially gone bad yet, we never ever touch the individual debtor's personal account. Instead, we sort of create a separate bucket. We debit the profit and loss account for the anticipated expense, and we credit a brand new, distinct account, the provision for bad debts account. Now, when we pull this all into our final accounts, here's how it plays out. Over on the balance sheet, you deduct the new provision from sundry debtors. This shows your true, realistic expected cash realization. Then, in the profit and loss account, you add this year's actual bad debts to the new provision you require. But, and here's the kicker, if you already had an old provision sitting in the trial balance from last year, you simply subtract that old provision from your total. And hey, if your old provision was actually larger than what you need now, that surplus swings right over to the credit side as a gain. Kinda neat, right? Okay, let's put all of this theory together into a realistic multi-step scenario. Imagine you're staring at a trial balance. Your total sundry debtors are sitting at 64,000 rupees. But down in the adjustments, you find out there are further bad debts of 2,000 rupees that haven't even been recorded yet. On top of that, management, following our good old conservatism concept, wants to maintain a provision for doubtful debts of 5%. Let's move to and see how this builds, because I cannot stress this enough. The order of operations here is absolutely critical. You cannot, I repeat, cannot calculate your 5% provision on that starting 64,000. Why? Because 2,000 of that is already gone. It's a permanent bad debt. It's not doubtful anymore. So, step 1. You must deduct the further bad debts first. 64,000 minus 2,000 leaves us with 62,000 rupees of good, albeit slightly doubtful debtors. Step 2. Now you calculate the 5% provision on that remaining balance, which gives us exactly 3,100 rupees. And that 3,100 rupees, that is the magic figure that drives our journal entry for the provision. We debit the profit and loss account for 3,100 and credit our provision for bad debts account for 3,100. The math cleanly and beautifully translates right into our books, ensuring we are safely, conservatively anticipating those future losses. Which finally brings us to this highly satisfying number on our balance sheet. To show the true, realizable value of our assets, we started with that 64,000. We subtracted the 2,000 actual confirmed bad debt. Then we subtracted the 3,100 provision for expected bad debts. That leaves us with a final, incredibly accurate, conservative asset value of 58,900 rupees. Wow, okay, we have covered a lot of ground today, right? From the sting of an unpaid invoice all the way to the strategic philosophy of anticipating the unknown. Which leaves me with one final question for you to ponder based on everything we explored today. When you look at your own accounts or the ones you're studying, are you anticipating your business losses accurately, or are you honestly just crossing your fingers and hoping for the best? Really think about it. Thanks so much for joining me for this explainer. Keep those ledgers balanced, and I'll catch you next time.